Good afternoon, everyone. Today, I'd like to welcome you to our final day in our pre-retirement seminar series. I know they always say that it snows during high school basketball tournament time, and I'm going to start keeping track of how often it snows during or around the pre-retirement seminar series time, because it always seems to do that as well. But I'd like to welcome you here today. We have two very good speakers. Our first topic today will be on Social Security, and then we will also be having a second topic on the university's retiree benefits as well. So our first speaker today is Rhonda Whitenack from the Social Security office here in the Twin Cities, and she's one of our most popular speakers here in the sessions, and so please join me in welcoming Rhonda. Thank you.
Well, good afternoon, everyone. I see a lot of familiar faces. This is great. I'm back for another year of Social Security information. We have a lot of good information that we are going to cover. Once again, Rhonda Whitenack. I work out of the Bloomington office, but I've actually been with Social Security for over 20 years. I started out in the Wisconsin offices, where I'm originally from, for the first part of my career, and then my husband was transferred over here to the Twin Cities area, so then I have been working in the Twin Cities area the second half of my career. But in addition to me being here, we also have a new representative with the Social Security Administration, and you're going to start seeing his face quite a bit. He's going to go out to the community and do a lot of retirement seminars, disability seminars, widow and widowers, Medicare seminars, and his name is Brian Rudolph, and you can see him in the back of the room. He's waving there. So he's also going to be helping with fielding questions and your personal questions. So you may have seen him out at the front table prior to coming in, but then we will also be at the table after the event too in order to answer your questions. So with Social Security, let's go ahead and start with the presentation, because we have a lot of information we are going to be covering today. So with Social Security, it's with you through life's journey. Look at this graph here. Look at this pie chart. We send out 67 million checks each and every month across the United States. So 67 million people wait for that Social Security check each and every month. The majority of those individuals are our retirees, our retired workers, but we also pay benefits to disabled workers. We also pay benefits to widow and widowers. We also pay benefits to children. If you're a retiree and you have a dependent child, if you are a disabled worker, you have a dependent child, or if you pass away and you have dependent children, those children would be entitled to your benefit also. So we send out 67 million checks across the United States. We are very, very busy. If you've ever tried calling our 1-800 number, if you've ever tried going into the Social Security office without an appointment and just taking a number, you can see how busy our offices are. So that's why we would like to communicate that we have different ways to do business with Social Security. You can go into our local office, you can make an appointment and do your application over the telephone, or you can actually file your application online. We have a lot of online applications that we are processing. If you do your application online, remember, you can speak to a representative. At the end of the application, there's a free format field where you can state, I would like a representative to call me, and then we will call you, one of our reps will call you and review the application with you in order to process it. So even if you do that application online, at least you send in the core of that app, and then we will take it from there, and then we're going to discuss whatever questions you may have with that online application. Okay, when to start receiving retirement benefits? This is the most common question I get when I go out and I speak to groups. When should I start up that retirement application? When should I start up that retirement benefit? Should I take it at 62, which is the minimum age? Should I instead wait until 65, where I can tie it in with my Medicare application? Should I wait until 66, because for many of you that may be your full retirement age where you're eligible for 100%? And so many of our people wait until 66. Then we have the other option where individuals want to delay taking their benefit, because you can actually increase your benefit by 8% per year between 66 or your full retirement age, depending on what your full retirement age may be, to age 70. So a lot of beneficiaries are waiting until age 70. 20 years ago, when I first started working with Social Security, I want to say the majority of the people that I processed for retirement were taking their benefit at 62. But now I'm starting to see this phase in of many people waiting for their benefit because they are taking advantage of those pensions, those annuities, those other retirement income sources that they've saved for all of their years, and then taking the benefit at an older age. Now, I'm not saying that's for everyone, but I do want you to know you have those options that are out there for you. Do your homework. Figure out what is the best time for you to take your retirement benefit. Now, if you look at the second paragraph, this is really important too. This talks about how the decision is going to be a personal one, right? Because you have to look at other factors. Are you single? Are you married? Are you divorced? Do you have a spouse that may be able to get a benefit on your record? Or do you have dependent children that may be able to get a benefit on your record? So all of those things, all of those pieces of the puzzle, you're going to need to put together in determining when that best time it is for you to take that Social Security benefit. Now, if you scroll down a bit, about midway through this paragraph here, you can see that there are several factors that we want you to consider. First one is, what are your current cash needs? I have a lot of people coming into the office at 62 saying, you know what, I've been out of a job for a while, I don't have a lot of money, I need that benefit at 62. We may calculate it out at 75%, but that current cash need is driving that person's decision to take that benefit at 62. So current cash needs. I have people coming into my office too, opposite side of the spectrum. They're coming in at 70 and cashing out at 132% because they don't need the money right away. And they're able to wait, they're able to delay that benefit and actually take advantage of that 8% per year. Okay, so current cash needs. Second item we want you to consider, what is your health and family longevity, right? Because if you're not the healthiest person, or you don't come from great genes where your parents live into their 90s, 80s or 90s, you might be making the decision to take that benefit earlier because that family longevity. Or opposite side of the spectrum, you have great genes and you're going to outlive your break-even age and you are going to wait to collect that benefit at an older age. Third item we want you to consider, do you plan on working in retirement? Because remember, if you work or if you leave your primary career and you open up your own business and become self-employed, the money you make from your job could affect the number of Social Security checks that you receive for the year. We have something called a work limit. And we're going to talk about those dollar amounts on a later screen. So are you planning on working in retirement? You have to consider that too. And then the last item I want you to think about is, do you have other retirement income sources? We do, Social Security does a lot of outreach and a lot of training with financial planners. We partner with financial planners. So I always kind of observe, of course, their presentation, but then after the event, I hear them talking to their clients, and I hear the advice that they're giving to their clients. And I overhear them saying, well, you know what? Let's look at your other retirement income sources. Let's look at your annuities and your 401k plan and your investment income. And let's see how we can pull that income in first before taking Social Security, because they are really pushing that client to look at that 8%, and they're saying to their client, where can you get a guaranteed 8% for your money? And remember that 8% happens between full retirement age and age 70, okay? So that's where you can gain that extra 8%, guaranteed 8%. That's different than, let's say your stocks did really well and you're getting a little bit more there. That's not a guarantee, where Social Security is at guaranteed 8%. So other retirement income sources. So those are the 4 items I want you to consider. Now let's look at that graph, at that bar graph, because I want to explain it a little bit and then let you know how you can get your personal percentages, because this graph pertains to those born between 1943 and 1954. If you were born between 1943 and 1954, you fall into that big baby boomer group that we are serving in our offices right now. Okay, so that's why this fact sheet pertains to those individuals born between 43 and 54. But we do have other fact sheets on our website for you if you were born outside of that age group. But just for the nature of the presentation today, let's use this graph here. So if we have an individual born between 43 and 54, their full retirement age is 66. That's when they can receive the 100% rate. So let's say this individual is 66, and we have an example of what their dollar amount would be, their Social Security dollar amount would be, and that would be $1,000, right? So let's turn that instead into a percentage. At 66, that person would be eligible for 100%. What if that individual decides to take that benefit at 62 instead? What would the percentage be? We're going to move that decimal point over, and that percentage would be 75%. So that person could start out taking their Social Security benefits, if they choose, at 62, and we would calculate that benefit out at 75%. Now, depending on when they take it, that percentage increases every single month the closer you get to age 70. You don't have to take it on your birthday. But if this person decides to take it on their 63rd birthday, what are they going to be calculated out at? 80%. At age 64, it would be 86.6%. At 65, it would be 93.3%. And then at age 66 would be the 100%. Now, what happens if they wait? That's when that clock starts ticking with that 8%, right? So if they wait until 67, it would be calculated out at 108%. 68 would be 116%, 69 would be 124%, and this person could max out at age 70 at 132%. 32% over and above what that 100% rate is. So this is something you definitely want to look at. Now, we're not saying that you have to work until 70 to get that 132%. You just have to delay taking that benefit to receive that 132%. Now, if you were born outside of 1943 and 1954, your full retirement age is right here, okay? And this chart is shown in your booklet, your retirement booklet, on page 4. So you can see what your full retirement age is going to be. Now, that means that if you are older than 66, this 132% is going to change. It's going to be a little bit less, right? Because if you're looking at that investment, it's going to be a few months less than the 4 years that we're talking about between 66 and 70. But I do have the number here. If you want to just take note of when your year of birth is and what your percentage is going to be, I can give that to you. So those born 1943, 1954, maximum at 70 is 132%. If you were born in 1955, max at 70 is going to be 130%. Born in 1956, max at 70 is going to be 129%. Born in 1957, the maximum at age 70 is going to be 128%. If you were born in 1958, maximum at 70 is going to be 126.7%. Born in 1959, the maximum at 70 is going to be 125%. And then if you were born in 1960 or later, where your full retirement age is 67, the maximum at age 70 is going to be 124%. And you can get those percentages on our website too at socialsecurity.gov. But I just want you to know that that isn't going to be for everyone. It just is going to be dependent on your year of birth. All right, so we already talked about the full retirement age. If you want to look at your Social Security benefit, if you want to look at all the years you've worked and all the income that we have on our records, on our database pertaining to the income that you've made all through those years, I recommend that you sign up for a My Social Security account. And we have a fact sheet on our table in the hallway that is titled My Social Security, How to Create an Online Account. It has the red bar across the top. Then, on the opposite side of the page, on the flip side, it is a step-by-step process on how to create a My Social Security account. You definitely want to do this. You want to look at your record. You want to see what we have recorded for all the years of work that you've done, because remember, we take top 35 years when we do this calculation. You want to see your 35 years. You want to see if you have any zeros floating out there. You want to make sure that that is correct. You want to make sure you're credited with every single penny you've ever made, because that is going to be the determining factor on how we calculate your benefit. So definitely sign up for a My Social Security account. In addition to that, you can also see the benefits that would be left to your family if you pass away. You can see the benefits that would be distributed to your family if you go on disability benefits. And then, like I mentioned before, you can see all of those years of work, which is really important. And you can see your personal benefit amount, too. So it's a really great tool to register for, to have, in order to plan for your retirement. Now, for those of you who have signed up for a My Social Security account, great, we're so happy about that. But for those of you who haven't or have tried and have trouble getting in, What you need to do is you need to, one, if you're locked out, if that means that whatever you are answering on those 5 questions or whatever information you're inputting when you're trying to register may not match with what we have at Social Security. So try it again, and you need to wait 24 hours before you try those questions again, okay? If you try it a second time, you're still locked out, wait another 24 hours, try it again. If you've tried it 3 times, probably there's something on our end or that's not matching with what you're putting in and what we have on our end. So then that's when you would actually have to go to a Social Security office, and with an ID, we can register you for an account, and you don't need to answer those 5 detailed questions. We can just bypass that. But definitely you're going to want to sign up for my Social Security account. Now, let's move to the next screen. Social Security is a foundation for planning your future. So we're looking at Social Security as being the base of your retirement income, but we are also hoping that you're going to rely on what? Your pension, your IRA, your 401k money, your investment income, your annuities that you have put away. Now, when you actually start receiving that Social Security check, the money you get from these other sources, they are not going to reduce your Social Security benefit. We're not going to penalize you because you are getting a pension. We're not going to penalize you because you are smart and invested your money. The one block up here that could affect your Social Security benefit would be money earned from work. If you're physically working and getting that paycheck, that could affect the number of checks you're going to get for the year. So that's something that you definitely want to look at. Now, your age when you retire, that may affect your benefits. Just like on the earlier screen that I showed you, that graph that I showed you, you can take your benefit at age 62. If you take your benefit at 62, it's going to be what we call a reduced amount, and it's going to be permanent. If you decide to take that benefit at 62 at 75%, that's how much you are going to receive for the rest of your life. It doesn't switch over to 100% when you turn full retirement age. If you decide to take it at 75%, it's going to be 75%. Or you can take it any month after age 62, or you can wait until your full retirement age, where you would be eligible for the 100% rate. Or you can say to Social Security, I know I can get that 100%, but instead, I like the idea of investing my Social Security and letting it accrue that 8% per year, and I want to max out at 132% at 70. So that's going to be your options. Those are going to be your options. Now, let's talk about how we determine that benefit amount, okay? How do we determine that benefit amount? Social Security benefits are based on your entire lifetime of earnings. We have been tracking all those earnings ever since that first job you held when you were 16 years old. So step 1 is we are going to look at all of your wages through all of those years, and we are going to adjust them for inflation. So that job that you held when you were 16 years old, we're going to bring that up to today's dollars. Step 2, we're going to find the average of your 35 highest years of earnings. 35 top years. It doesn't have to be consecutive years either. Just top 35 years across the board. Step 3, the result is going to be average index monthly earnings. We put another formula on top of that, and we determine your, what we call primary insurance amount, your base amount. And that's what we use when we do those different percentages. You can look at your primary insurance amount on the My Social Security account tool, the one that you're going to sign up for, okay? Now, this is how we determine your benefit amount. Once we look at this benefit amount, then we're going to look at these percentages here, right? And we're going to slot you in to that month, to that year and that month that you're going to choose to take your retirement. So let's say I have an individual born between 43 and 54 who is deciding that they're going to file at 63 and 6 months. What is the percentage going to be? 83.3%. I'm going to take their application. I'm going to do this right here, this calculation right here. Then I'm going to take 83.3% of their primary insurance amount, and boom, they are going to be locked into 83.3% for the rest of their life. That is the choice. That's your choice. That's that person's choice. Now, the next question I always get is, will that benefit ever go up? Once that retiree decides to take it at 83.3%, I always get the question, will it ever go up? There's a couple of ways your benefit could go up. One would be cost of living increase. If you get a COLA that year, right, your benefit can increase. The second way your benefit could go up would be if you decide to go back to work after we do that initial calculation. So you're coming in today, and I am doing this calculation here for your benefit, and I'm starting to pay you 83.3%. Well, I did that initial calculation today. That means that I took all your top 35 years from your history of work, and I started paying you today. But then you go back to work in 2019. You decide to pick up a part-time job, or the university calls you back, and you're going to go back to work. So you go back to work in 2019. That's a new year. You still have to pay FICA taxes. That's just IRS law. So you go back to work, you're paying new FICA taxes, but that 2019 year might be a high year. And if that's a high year, what's going to happen then? When you file your taxes, that W-2 is going to be sent to Social Security. Social Security is going to run that W-2 through our computer database, and it automatically recalculates. Social Security's database automatically looks to see if that's a high year, and if we can replace one of these low years where we did your initial calculation, we're going to replace a low year, and your benefit is going to go up. Your benefit is going to increase. And that's something called an automatic recalculation. You don't have to ask us to do this. It's automatic when that W-2 hits. Now, we do send you a letter, though. Once we do that recalculation, and if we replace a low year, and if your benefit is going to go up, we're going to send you a letter stating, based on your new 2019 earnings, your benefit is going to increase by X amount of dollars. I usually don't see it going up by hundreds of dollars, but I usually see an increase of $10, $20, $30, depending on how much you make, right? Now, I've done sessions with university faculty, and many of you work past 65, many of you work past 66, some of you even work past 70. So you are continuously being recalculated, and your benefit is continuously going up because these are high years here, and you're replacing these low years from when you were in your 20s. So that's where work can definitely help you increase your benefit amount. Now, it's definitely going to help me, just personal story, because I have some zeros floating around in those 35 years. Because when we had our daughter, I stayed home and took care of her for a couple of years. So I have 2 zeros floating in my history of work. So if I go back to work after they do my initial calculation, that new year of work is going to replace those zeros, and my benefit is going to go up. Okay, so that's how working past your full retirement age, or working past that initial calculation, could help you in your future. Now, I also want to mention that last column, and that has to do with spousal benefits. Spousal benefits is so misunderstood. We're going to talk about spousal benefits in detail. I'm going to show you some examples, but I do just want to give you a glimpse of these percentages because so many spouses walk into our offices each and every day, call our 1-800 number each and every day, and say, I want his benefit first because he made more money, or I want her benefit first because she made more money. I want to take theirs first and then save my own. It just doesn't work that way. Okay, spousal benefits, number one, that legislation was created to protect those spouses who had little work or no work at all. Think about a generation, 2 generations before us. How many people solely relied on spousal benefits? I know my mom did. My mom was a stay-at-home mom. She had a few years of work here and there, but never enough credits on her own work record to get her own benefit, so she was solely tied to my dad's benefit as a spouse. But now I'm seeing those demographics change, though. Different for me, different for my sister. So these are the percentages. So if my dad is 66 and he's going to take his benefit at 100%, which is $1,000, and my mom is 62 and she's eligible as a spouse, what is her percentage going to be? 35%. What is her amount going to be? $350. So it's not 50% across the board. And if you have your own work record, we're going to pay you on your own work record first before we pay you as a spouse. And we're going to show some examples on a later screen. But you can see how that spousal amount increases month by month also, right? Depending on the age of the spouse, that's going to be the percentage that they're going to receive, or possibly be eligible for, I should say. All right, so we have something called a benefit calculator. I love this calculator. I like this calculator way better than I like that Social Security statement, because this shows those true numbers. It shows that monthly benefit that you can receive. So the first page of this calculator will ask for identifiable information, then you go to page 2, and then this is where you can feed in the scenarios. If you look at the bottom of the screen, you can say, okay, Social Security calculator, I want to know how much I'm going to be eligible for if I stop work at this age and if I take my benefit at this age. And then you can project future earnings too. So you can put zeros in there if you're going to not work. Once you stop that work, if you have 0 earnings in the future, you're going to put 0 in there. But if you decide that you are going to stop work and then you have future earnings, you can put that in there too, and then show when you're going to take that benefit, and then you hit that send button. Behind the scenes, it does this calculation right here, and then you will see instantly on the screen what your monthly benefit is going to be. And the reason why I say I like this better than that Social Security statement is because that Social Security statement projects that you are going to work until that age. So that age 70 amount you see on that Social Security statement, it's projecting that you are going to work until 70 to get that benefit. And many people don't take that, don't work until 70. Many people stop working at 63, have 0 earnings from 63 to 70, and then pick up the benefit at 132%. So this is where you're going to do that calculation on your personal situation of whether you're going to have future earnings or not once you leave the university, and then when you're going to pick it up, when you're going to actually apply for benefits and take the benefits. So it's a really excellent calculator to use. Speaking of work, that takes us to the next screen. If you plan on working, can you receive benefits? Or if you plan on working, what are those wages going to do to your benefits? Well, we have 3 tiers here of work that I'd like to talk about. Let's cover the bottom one first, and that is in the month you turn your full retirement age. So think about when you turn 66 or 66 in 2 months. In the month you turn that full retirement age and continuing, you can make as much money as you want and still be eligible for each and every one of your Social Security checks. Now, if you're under your full retirement age, there is a limit of how much you can make and still receive all 12 checks. And that in 2018, that amount is $17,040 gross per year. So you can make up to $17,040 gross per year and still be eligible for all 12 of your checks that year. Now, if you go over that, what's going to happen? If you go over that $17,040 gross per year, for every $2 you go over, you will not be paid 1 Social Security dollar. So you're going to have to figure this out, and we have a calculator that will help you do this too. You're going to have to say to yourself, all right, I'm going to go back to work. You're going to talk to your boss. You're going to figure out how many hours you're going to work. You're going to figure out how much your pay is going to be. Is it going to be salaried? Is it going to be hourly? You're going to have an idea of how much you're going to make. Then you're going to call Social Security, and you're going to say, okay, Rhonda, I'm going back to work, and I'm going to make $27,040 per year. I'm going to look at that limit, and I'm going to say, you are $10,000 over the limit. But even though you're $10,000 over, we're not going to count all $10,000 against you or against your Social Security checks. We're going to do the 2-for-1. So even though you're $10,000 over, we're going to do the 2-for-1 and really only count $5,000 of that money. Social Security is going to say, because you are over, you are not going to receive $5,000 worth of benefits for the year. So then we're going to do some math, and we're going to say, all right, if your Social Security check, your Social Security benefit is $1,000 per month, and you are not going to receive $5,000 worth of benefits for the year, that means you're not going to be due, you're not going to be eligible for your January, February, March, April, and May check. But you will be eligible for June, July, August, September, October, November, and December's check. So that means you are going to make $27,040 from your job and still be eligible for 7 checks from Social Security. That's how work, wages, and Social Security benefits offset each other. Okay? Remember, when we look at these limits, when we look at these numbers, we are not counting that pension you're receiving. We're not counting that annuity or that investment income. This is just money earned from your job, from your work. Now, if you decide to retire mid-year, and I know a lot of our educators, decide to retire mid-year. So I have somebody coming in, they're a teacher, they decide to take their benefit in June, and they look at this earnings limit and they say, Rhonda, I have made way over that amount of money. I've been working since the beginning of the year. That's okay though, because anything you earned prior to you taking your benefit, Social Security does not care about that. Why would we penalize you for money that you've earned before you've even picked up any Social Security benefits, right? So we don't care about anything you earned prior to you taking your benefits. But once you sign up, once you start taking those benefits, that's when we are going to need to know how much you're going to make. So I tell that teacher, you know what? You're probably not going to work June, July, and August, but come September, you're going to start getting these phone calls to come in and teach, right? So that means that if you decide that you're going to go back to work, we're going to have to look at the monthly amount. We're going to take that $17,040, divide it by 12 months, come up with a monthly amount. And as long as you stay underneath that monthly amount of $1,420, you're going to be fine. You're going to be eligible for all of your checks. But if you go over, then you won't be due that check, that Social Security benefit, that Social Security check. But then starting the first of the month of the next year, you're going to be offered, or you're going to be able to take that $17,040 and use that to your advantage anytime. You don't have to, you're not broken out to what we call a monthly rule. That monthly rule is only that first year that you take your benefits if you decide to retire mid-year. Okay? Now, if you decide to retire in June and you're waiting for a check from the university or from your job that's going to be accrued, let's say a check or a bonus of accrued vacation pay or sick pay, and you don't receive it until after you take your Social Security benefit, we aren't going to count that against you. Okay, that's called a special payment under Social Security rules and regulations. You can look this up on our website. We have a nice fact sheet about it too. We are not going to charge that against you because that's actually money paid to you for work that you did prior to going on benefits. You just need to let us know about it. All right, so when you do your application with us, either let us know at that time or once you receive it and you haven't told us about it, call us up and let us know. All right, because if you don't tell us, then what's going to happen is at the end of the year when we get that W-2, it's going to show up on your W-2 and it's going to look to us like their earnings, like you made that money and didn't tell us about it. And then we might apply that to the earnings limit where it should not be applied to the earnings limit because, like I said, that was money earned for work that you did prior to going on benefits. So that's called a special payment. And then this middle column here, or this middle row here, 2018, is the $45,360. That's the limit. That's the money you can make in the year that you turn your full retirement age. So think about those months leading up to your full retirement age, right? You can make up to the $45,360 and still collect a benefit. Because once you hit that month that you turn your full retirement age and continuing, you're going to drop into the no limit category. So do the math here because you can really work this to your advantage if you are one of these individuals that's really hoping for that 100% rate or wanting to file for that 100% rate. I hope that makes sense, okay? Because if you take it in January and your birthday is in April, right? So April 1, you're going to drop into the no limit category, but that means instead of waiting for April for the 100%, you might be able to pick it up in January instead at 98%, because most likely you're going to make under $45,000 in January, February, and March, those months leading up to your April birthday. All right, and we have the earnings limit calculator online. You can use this. You need two pieces of information. One would be an estimate of how much you're going to make from your job, and two would be your benefit amount. You plug those numbers into this calculator, and it will calculate out how many checks you're going to be due that year. All right, I am going to just break real quickly and see if there are any questions. Okay, now I'm going to move on to the next screen. All right, we'll have questions at the end of the session too. So in addition to the retiree, who else can get benefits? We talked about spousal benefits earlier, right? So a spouse can receive benefits at age 62. That's the minimum age. Or if we have a spouse at any age and caring for that's caring for a child of the worker under the age of 16, that child's under the age of 16, or a disabled child, then that spouse does not have to meet that age 62 requirement. Then we also have a benefit for divorced spousal benefits. Now remember, for divorced spousal benefits, you had to have been married for 10 years or longer before we can look at paying you anything under a divorced spousal benefit. For a regular spouse, it's a year or longer, at least a year or longer of marriage. For divorced spouses, it's 10 years or longer in order to be paid a divorced spousal benefits. Now, spousal benefits and divorced spousal benefits, they pretty much align with the rules and requirements. So if you are a divorced spouse, you have your own work record is higher than what you can get as a divorced spouse, you're not going to get anything as a divorced spouse, okay? So let me give you some examples of how these spousal benefits work. The three primary cases that I see, spousal benefits that I see in the office, would be similar to one, like my mom and dad. My mom was the stay-at-home mom. She didn't have a strong work record. She didn't have enough credits on her own work record. So when she went down to the local Social Security office with my dad, first of all, they took my dad's application, and my dad started receiving his benefit, but they still looked at mom's because they realized that she was of retirement age. So they looked at mom's record and they said, okay, Maria, you don't have enough credits on your own work record to receive a benefit. But we're still going to look at your husband's because you're of retirement age and you meet the rules and regulations. So let's see how much you can get paid as a spouse. So mom was actually full retirement age, so she was actually eligible for 50%. So dad's benefit is $1,000. How much is mom going to get? $500. So mom was eligible for $500 off of my father's record as a spouse. Now, if dad would have gotten up and walked out because let's say he wanted that 132%, mom would have had to walk out the door too. Because she was only eligible for her spousal benefits once dad picked his up. She was solely tied to dad's. Okay? So that's the spousal situation with my mom and dad. Stay-at-home mom, she's solely tied to dad's. She's only eligible to get her benefit rate when dad decides to pick up his benefit. That's the first case. And I saw a lot of those cases 20 years ago. Then I started seeing kind of the demographics change as I worked for Social Security for these 20 years. Then I saw the middle group, which is what we call dually entitled. That's where you're entitled off of two work records. This is a case, let's say, similar to my mom and dad's. Let's say mom was eligible. They calculate out her benefit and they say, okay, Maria, you are eligible for $300 on your own work record. Social Security still is going to look at dad's. They're still going to look at dad's work record. And they're going to say, all right, you're eligible for $500 off of your husband's, so you are duly entitled. How would we pay my mom if she's duly entitled? Social Security would pay her $300 on her own first. Okay, so mom gets her $300 month by month by month. But they still look at dad's, and she can get $500 off of dad's. So because she's duly entitled, she would get an extra $200 off of dad's to equal the $500 amount. Okay, she gets the payment of the highest amount. Now, if dad would have walked out the door because he wanted the 132%, mom would have only gotten her $300 month by month by month until dad decides to file. Once dad files, that's when she's going to get the extra $200 off of dad's. Okay, that's scenario number 2. Now let's take scenario number 3, my situation. I've worked ever since I got out of college, same with my husband. He goes in and he files. He's eligible for $2,000 per month. That means the max I can ever get off of his is what? $1,000, right? I go in and I file on my own work record, or I go in and I file for benefits. They look at my own work record. Social Security determines that I'm eligible for $1,500 on my own work record because my $1,500 is more than what I can get as a spouse. I'm not going to receive anything as a spouse, okay? So if we have 2 high income earners, the max for a 66-year-old is $2,755. If we have 2 maximum earners in the household, each one of them are going to receive $2,750, $55, I should say. So those are the 3 main spousal scenarios that I see. Once again, divorced spouses, similar situation. If you are going to receive your benefit and it exceeds more than you can get as a divorced spouse, you're not going to receive anything as a spouse. Now, I just talked to a couple earlier before we came into the session here, and they are under this what we call filing option, this loophole that is closed to most of us, but is still open to those born in 1953 or earlier. So if you were born in 1953 or earlier, take note of this. If you were not born 53 or earlier, just plug your ears because it's going to be confusing, okay? So if you were born 53 or earlier, you still have this filing option to what we call file and restrict. That's where one of you takes the 50%, the second member of the couple goes on benefits, starts receiving benefits in order to entitle that 50%. Then that 50% person is going to wait, accrue the 8% per year, and then max out possibly at age 70 at 132%. Okay, so that filing option is still open to a small group of baby boomers, those born 53 or earlier. You can Google file and restrict. You can go on our website and plug in file and restrict in the search box, and there's going to be more information out there for you. You can talk to me, you can talk to Brian after the session, and we will go through the process of that file and restrict option that possibly could be open to you. Okay, so then we have children's benefits. Children are always protected, not married under the age of 18, or under 19 and still in high school, or not married and disabled prior to age 22. So we will talk to you about that eligibility too when you file for your benefits. Okay, so in addition to that, we have survivors benefits. Who can get survivors benefits? You may be eligible for widow or widower's benefits depending on your age. The earliest age you can collect a widow and widower benefit would be age 60, which is different than our retirement, right? Because our retirement, the earliest age is 62. If you are eligible for a widow or widower benefit at age 60, the starting percentage is 71.5%. So it's higher. It's more than you can get as a spouse. We also have widow or widower's benefits for those who are disabled. So if you are a widow or widower and you are disabled as early as age 50, you apply for the disability benefits, you may be eligible to receive that benefit. That third bullet is really important. At any age, if caring for a child under 16 or disabled. So the any age is what's important because that means that if something happens to me tomorrow, and I've been working 20 plus years and I paid a lot of FICA taxes, my benefit is then left to my husband and our daughter. Because my husband could possibly get it because our daughter's under the age of 16. She's 14 years old, all right? So he's 45, so he would meet the any age caring for our child who's under 16. Although, you know what, he's working full-time, he's making over the limit. That means he most likely will not receive the widower benefit, but our daughter who's 14 will get my Social Security benefit from age 14 all the way up until she's 18 years old. Okay, so that's the life insurance piece that we're really investing in. That's the life insurance piece that we're leaving behind for our family. Then we have divorced widow and widowers. Any kind of divorce case, you had to have been married for 10 years or longer in order to be able to receive that divorce benefit. And I believe in your packet here, let's see, that shows the PowerPoint. There are two screens, and one of them shows the screen that has the details on spousal benefits, and also that has the details on divorced spousal benefits. Yep, so on page 7, benefits for divorced spouse, benefits for spousal benefit computation. All right, so you can look at that on your own time, and also with the disability piece. So now we are going to move over to Medicare. All right, who can receive Medicare? The first thing I just want to clear up is with Medicare, do not mistake Medicare for medical assistance or Medicaid. Those are state-run health insurance programs for lower income, lower resource people. I just hear people interchange Medicare with Medicaid all of the time. But Medicare is the piece of legislation that was passed back in 1965 as a health insurance legislation to protect those individuals who are eligible, or a spouse that possibly could be eligible, or a widow or widower that possibly could be eligible. So Medicare, the age for Medicare is still age 65. That is not increasing like our benefits piece is increasing. And the reason why we say you can get Medicare 65 or older is because a lot of people, a lot of our future beneficiaries are waiting to get their benefits, waiting to sign up for Social Security. They're working past 65, and because they're working past 65, they still hold that private health insurance policy through their employer. So you still have your university health insurance, as you're working past 65. That means you do not have to sign up for Medicare and you will not be penalized. Unlike if you start going to your mailbox a couple months before you turn 65 and you start getting inundated with all this information that's saying you have to sign up because you're going to be penalized. Well, that's not information coming from Social Security, and that most likely is not information coming from CMS. That's information coming from private insurance companies that know you're nearing that age 65 marker. They know that you're going to need to, or for many people, they need to pick up what's called a supplemental plan. But if you're working and you hold that private health insurance policy, you do not have to take it and you will not be penalized. Okay? And that's called special enrollment period. So if we look at Medicare and we look at the different pieces of Medicare, the Part A and the Part B, those are our original pieces of Medicare. That's the legislation that was passed back in 65. It was meant to protect you for Part A, which is the hospital insurance. It does not have a monthly premium, but it does have a deductible. Then we have Part B. Part B is a supplemental medical insurance that covers outpatient, clinic, and doctor visits. Part B, B as in boy, is a piece that's going to cost you $134.80 per month. And if you are on benefits, it comes right off the top of your check. If you are not on benefits because you want to wait for the 132%, then we are going to bill you for that Medicare. Part B is the piece that covers 80% of doctor, outpatient, and clinic visits. So if you are ready for Medicare and you are going to pick up your Medicare Part A and B, that means that you're going to look at that 80% policy and you're going to say, okay, who's going to cover me for my other 20%? That's where you're going to talk to your benefits department because they have those plans as a retiree, right? You're going to be entitled to retirement health insurance. So then that's where you're going to look at where you're going to pick up or who you're going to pick as your provider for that 20% policy and also that prescription drug policy. So it's going to be Part A free plus the $134.80 plus the 20% policy, which is going to be question mark. We don't know who you're going to select for that, plus your prescription drug policy, which is going to be question mark on the price because we don't know who you're going to select for that prescription drug either. So you add up all four pieces, and then you will come up with your total for your health insurance coverage in your retirement years. Now, I also want to mention that premium of $134.80. That's the base premium of how much that is going to cost you. For about 4% of our beneficiaries, that premium may be higher, and that's because you're in a higher income bracket. And the reason why is that $134.80 is really only 1/4 of what Part B actually costs. The federal government is subsidizing the other 3/4. So there was a law that was passed a few years ago stating if you are in a higher income bracket, you are going to have to pay more for your Part B because the government is not going to subsidize you 3/4 of that amount. Now, if you want to find out how much that is going to be, go on our website, and actually, I believe it's a screen that's in your packet here also. Let's see, let me just quickly look here. Yep, so on page 14, it shows the standard Part B premium, and then it will show what your modified adjusted gross income is going to be, and then what your monthly premium amount is going to be. This is actually for 2017. It has gone up. It's a slightly higher than that. Just go on our website. You'll get the new numbers for that also. And then you can figure out whether you are going to have to pay more for your Medicare Part B. It's called special enrollment period. There's details on the screen here as well as on our website about how the special enrollment period works. Do you need to sign up for Part A? So with Part A, that is the hospital piece. I see many people signing up for Part A as a safety net. They're working, they hold their group health plan, but if they're ever hospitalized, the first, I should say the group health plan would be primary payer, and then basically the Part A hospital is like a safety net for that bill that comes from the hospital. Now, health savings account, do they have health savings accounts? HSAs that they're able to contribute to? Okay, so if you have an HSA and you're contributing to an HSA, we have to remember that with Part A, there's a 6-month retroactive period for Part A. So you have to plan this correctly where you cannot, first of all, you cannot contribute to an HSA and have Part A concurrently, because they're both IRS subsidies. So I recommend that you plan this out and stop contributing to your HSA at least 6 months prior to you going on Social Security benefits, because once you sign up for Social Security benefits, Part A is automatic with that Social Security benefit, and we're going to give you what's called a 6-month retro period on that Part A, and so you don't want to be contributing to an HSA during that retroactive period. All right, so just make sure that you are that you familiarize yourself with this rule, and then we also have the IRS publication 969, and that has more details on the HSA and the Part A. Okay, applying for benefits, 3 options available. You can apply online, just like I mentioned before. You can make an appointment, and if you make an appointment, you can call the 1-800 number, and your appointment can either be in the office or over the telephone. It really is the best to make an appointment if you do want to sit down and talk to a representative, just because of how busy our offices are, like I mentioned before. This is what you're going to need, the different proofs that we're going to need. Most of these actually we can get electronically, so we're able to verify, your age and citizenship automatically through the system. But we put this list up because this is what we use in order to be able to adjudicate that application. This is a really good toolkit. This is a webinar that we have on our website. This is just a really good webinar, so I recommend that you go ahead and take a look at that. And then this is what our website looks like. All the information that I talked about today is on this on our webpage. You can sign up for a My Social Security account. You can look at those calculators. You can actually do those calculations with the retirement estimator. We have FAQs, and then also our online applications are on our website. The application for retirement, disability benefits, Medicare benefits, that's all on our website. It's really an awesome tool. I'm just so proud of all the people that work so hard to make the website as user-friendly as possible and to be able to have all those online services available. Okay, so I just have a few minutes here to take a couple of questions, and then I want you to know that I'm going to be out on the table, and Brian also is going to be out at the table in order to answer your personal questions. Okay, so if I can just open it up for a couple of questions. Yes, right here.
Survivor's benefits, you said it starts at 71.5% of what? Of your deceased spouse's overtime age or what?
71.5% of your deceased spouse's primary insurance amount. So we're going to do the same calculation for your deceased spouse. We're going to take the top 35 years, come up with a primary insurance amount, and then pay you 71.5% of that.
The primary insurance, what you would have gotten at 65, even
At full retirement age.
if
Mhm. Yes, yes. Now remember, that percentage goes up every month also. The closer you get to your full retirement age, the maximum would be 100% at your full retirement age. Yes, you're welcome. Question right here?
Covered under a spouse's workplace insurance, and they're younger than you, can you refuse Part B of Medicare?
Yes, you can, and what's going to happen then is you're going to fall under that same special enrollment period where when your spouse decides to leave their job, that's when that form, that employer form, needs to be completed by their HR department, proving to us that you were covered all those months or all those years after 65. Yes. Okay, right over here.
Yeah, those of us at the university on what's called phased retirement, after retiring, have 2 years of health benefits paid by the university. Is there any advantage to not taking that and going on to Medicare directly?
You know what? We are going to have Melinda cover that on our next session, okay? She's going to cover the details of the retirement health insurance piece. And then right back here.
On the news, it talks about how in a few years, Social Security will be out of money except for the new payments coming in. Do we need to plan for that?
Well, I think we need to educate ourselves on what that means on the solvency issue, and I'm just going to do a quick take on this, okay? Because because it's important, and we just need to, first of all, understand how Social Security works. It's a pay-as-you-go system, right? money we're making right now, FICA taxes that we're paying right now, going into the Social Security Trust Fund, and it's being paid directly out to those current beneficiaries. So our tax dollars and the number of workers in the workforce is making that Social Security, that Social Security base grow, right? So we have a lot of money in there that's being accumulated and being paid out to the workers. Back in 1960, there were 5 workers per 1 beneficiary. Right now, there are only 3 workers per 1 beneficiary. In 2030, there are only going to be 2 workers per 1 beneficiary. So only 2 people's FICA taxes to pay that 1 beneficiary. So that means that the number of workers in the workforce paying Social Security tax dollars is going down. But what are we seeing going up? The number of people that are eligible for benefits. That baby boomer group is what's really, really going to hurt us, because that many more people have to be paid benefits. Right now, there are 35 million people over the age of 65. In 2030, when that hits, when they're saying that the solvency is going to come at a crossroad, there are going to be twice as many people that we have to pay. So our actuaries are telling us that we have enough benefits to pay individuals until the year 2034. In 2034, we are only going to have enough money in the Social Security Trust Fund to pay 75% of those beneficiaries that are due. That's if we absolutely do nothing to change Social Security. That is worst case scenario. So that's why we have to look at, okay, we know that there are fewer workers in the workforce that are going to be paying tax dollars, and we know that there are going to be twice as many beneficiaries that we have to pay. We already know that. So what are we going to do? What changes are we going to make to the Social Security system in order to make that Social Security Trust Fund solvent beyond 2034? There's a couple of options that are already out on the table, and if you want to see the details, you can go to our website under our actuarial report, and it will show all of the proposals that are being made. Just to name a few, one of them would be raising what we call the tax wage base, because right now we pay FICA taxes up to $127,000. So once you hit $127,000, you pay no more FICA taxes over and above that. So Bill Gates right now, once he hits that $127,000, which he probably did the first second of 2018, right? He pays no more FICA taxes over and above that. So one of the options, or one of the proposals, is raise that tax wage base, okay? Now, would I support something like that personally? Yes. Why would I support it? Because I don't make $127,000, right? But would my neighbor support that? Absolutely not, because he makes way more than $127,000. So it's going to be a personal decision on how we want to move forward with this, right? Another option would be, should we do away with the cost of living increase? That's another proposal, doing away with the COLA. Would I support that? Probably. Would my parents support that? Absolutely not, because they're waiting for that COLA every year, right? Should we do away with spousal benefits, children's benefits, widows' benefits, divorce spousal benefits? So there's all of these options that are out there to make Social Security solvent beyond 2034. And that's where it's going to be up to us as voters, as taxpayers, to decide what we want those changes to look like. So definitely educate yourself on those proposals, and then the only way to do it is communicate this to our congressional representatives who are going to be making that decision on how to change Social Security as we move forward. But thank you for that, and that was my little Social Security solvency minute PSA. All righty, so I'm going to end the session here, and thank you very much. I'm going to be in the back table. Brian's going to be at the back table to answer your personal questions also. Have a great afternoon, everyone.